Ian Beattie is the co-CIO and head of global emerging markets at NS Partners. Ian is the manager of the Nedgroup Investments Global Emerging Markets Equity Fund, which combines macro, liquidity, and country analysis along with rigorous bottom-up stock selection in a portfolio of about 75 to 90 stocks. Ian and his team have been investors in emerging markets for about 25 years now, which is interesting because the topic of his presentation is emerging markets, we've only just begun. Ian, over to you.
Good morning. Well, what a year. Who's playing speaker bingo? I hope we have the word unprecedented down as well as virus. 2021 has certainly taught those offering heroic forecasts this time last year some humility, eh? Right, well, I know we're on a tight schedule and I want to allow lots of time for questions. So let's get right into it. Performance for the Emerging Market Fund for the year 2020 was up 23.9%, 7.49 ahead of the benchmark, bringing the since inception for the Nedgroup Emerging Market Fund to up 36.8%, which is about 12.4% ahead. So, what went right and what went wrong for us in 2020? Good stock selection in China and Taiwan especially throughout the year, and South Korea, Russia, Poland and Greece too. Sector-wise, all important this year, of course, it was industrials, IT, communication services, and financials. I think if you didn't get some of those sectors right this year, you were in trouble. It didn't all go our own way, of course. We had poor stock selection in India, Thailand, and Brazil. And all of these were COVID related, of course. Two of them being in tourism and travel stocks in one country in particular that's very tourism and travel sensitive. So on this slide, we just pick out three standout performers that were positive and three that were negative to add a bit of color, to give you a little, sort of edited highlights, as it were, of the year. And the three standout outperformers this year were Contemporary Amperex Technology, or CATL, and LG Chem. Now, both of these are EV battery makers. Growth, you say, I can hear you from here almost. Yes, that is true. But there is more, in my opinion, because this sector is oligopolizing. When that happens, the market, the big start to consolidate the market and get more pricing power. But in this case, it's interesting to see how they've done this. They've done it by outspending in R&D and CapEx until there's only 3 or 4 other players that can probably keep up. And of course, as those dollars of CapEx and R&D increase and these companies improve their competitive advantage over the rest of the pack, at that tipping point where they become dominant, there's only 3 or 4 really that can keep up with that level of spending, the percentage of sales, that R&D or CapEx as a percentage of sales, starts to drop and eventually drops quite dramatically as a percentage of sales or as a percentage of the balance sheet, which of course means returns in this growth environment start rising and rising quite dramatically if you're the big winner with the competitive advantage. I mean, this is what happened at Tesla, right? Now, I'm not justifying the valuation here, but this is how their returns started to soar relative to the less efficient incumbents. And then, of course, you add in index changes and liquidity to the mix. And this is what's happening in these sectors too. It's also happening in solar. It's something we like to keep an eye on. It's really profitable when you catch these industries that were ruthlessly competitive. And then although they stay incredibly competitive, they start to become an oligopoly and dominant. It's a very different approach these companies take to, say, the Saudi Arabia that tries to restrict output. These ones just keep outspending their competitors. For the poster child on this, I think you look no further than one of Asia's finest, Taiwan Semiconductor. But I haven't got time to talk about that just yet. Sany Heavy had been another big winner for us this year, high quality construction equipment player in China. And it's, again, something else that we see again and again and that we can learn from. Many years ago, it was the cheap player, but the best but probably the best of the locals in a market where really it was the big foreign names, JCB, Caterpillar, Komatsu. They were the ones that dominated. Now, last time I spoke to one of their customers, a big Chinese firm, I heard that Sany Heavy is now over half their fleet. And this is a well-trodden path. You take over the domestic market, you scale up your competitive advantage in the cost base and then technology, and then you can go global. More on that later, maybe. But this is what China will do to the world, which is, of course, exactly what US firms did 50 to 100 years ago. On the lose as well, travel and tourism, as I've already said, still dominated even by the end of the year, despite very good bounces in the fourth quarter. Nobody fancies a return to a once crowded casino at the moment, or even a mid-market business hotel, still rather quiet. But we obviously checking these frequently. And that hotel operator that cost us has cut costs again. It was already the lowest cost provider there and the most efficient company in its sector. And this is what good companies do. They come out of these crises stronger than ever, with lower costs and fewer competitors. What do we do? Well, in the second quarter, our liquidity analysis showed us a bull market was starting as the market collapsed and the economy stopped dead. It was screaming buy, but buy those with strong returns on capital, no downgrades on the horizon, more liquidity sensitive. So there's the internet names, the growth names, COVID beneficiaries. But then later in the year, around Q3, we saw the liquidity move into the economy, away from financial markets. And we saw the Chinese economy experience the amazing V-shaped recovery. So we started to buy the economically sensitive, the operationally geared. You might call them cyclicals. We even picked up a couple of airlines, but low-cost carriers, not flag carriers. Intra-region, not intercontinental, with good business models. And that meant reducing China, which was broadly right. We still like it. We just think the economy is losing momentum. The People's Bank of China is keeping things tight, and we just think we'll be able to buy it better later, because we still like it, and there are some tremendous stocks there. They get very excited when you start looking at all the amazing companies there. But it's losing momentum, and I think it's a deliberate, more cautionary policy. So actually, it's probably a lower risk investment, but also less exciting at this current moment in time. India isn't the disaster everyone thought, so we added to that. Taiwan, of course, on the right-hand side here, has been amazing. The best COVID response by both the governments and the people. Not that the WHO will tell you that, because it doesn't recognize Taiwan, of course. And it also has great companies in Taiwan. China, Taiwan, Vietnam, by the way, have all powered through this year, exporting more and more. Amazing performance. Mexico, well, we added a bit, but it's a good place to, but you can't get too excited, but it is a good place to get copper exposure. South Korea, very much a cyclical market. And we added here, and it went well. We timed that well, but never really got enough. So sorry about that. We got the macro right. We found some great stocks, but not enough, and we didn't really get aggressive enough. As for South Africa, well, what can I say? The details. Now, don't worry, I'm not going to read all these out to you, but if you want them, we stand for transparency for what we invest in, and as well as also how we communicate with our investors. So it's all here. More is available. If anyone wants, just ask your Nedgroup representative. But you can see here good stock selection in all regions, especially China and Taiwan, as I said. But you needed this year, to have this type of stocks right. You might call it sectors, but really you needed high duration, returns on capital that weren't going to get downgraded. And then later on, and lack of economic sensitivity. And then later in the year with that rotation, you needed to make sure you had that operational leverage. It was all about technology and internet at the right time. Jack Ma and so and so. I'm really pleased our macro work, which is normally steering us to countries, was a great tool for this year. But then a liquidity analyzing process should be good at the moment, shouldn't it? When we have indicators at levels not seen in peacetime since the American Civil War, or in the UK, maybe even since the Middle Ages. but it's did its job this year and really helped us. And that's what we're seeing here, really. The huge outperformance in consumer discretionary, e-commerce that is really behind that, which then retreated. And then the rally in materials. So you can see very clearly on that left-hand side there, the rotation. And our macro analysis really helped us navigate this year. Elsewhere, we got the IT right too, but you really needed to, didn't you? We didn't really get the healthcare. So that's one for our peer review mechanism. That'll be painful, but it has been a rewarding experience already. This is the same attribution by sector. Again, you can read all these later at your leisure, but it says the same thing. Just some highlights here at the stock level, because I think that's always interesting. Well, I've already talked about Cattle and LG Chem. You can see here the size of the moves, very, very big moves and big contributors to the P&L. And yes, we have reduced most of these big winners already to keep things tight. As you go through the next few slides, you'll see that we see liquidity starting to wane a little, actually. So we didn't want to be riding these all the way up and then all the way back down again. We do like them long term, hence most of them have just been reduced, not sold completely. But yeah, taken profit in Cattle and Dada and Sani Heavy even, and Longy Green. Longy Green's doing exactly the same thing as Cattle and LG Chem, oligopolizing the solar market in this case. Dada Nexus is a e-commerce play with JVs with Walmart, so it's groceries in China, and also JD.com. It's our preferred play there. We think they're adding a system rather than just the last mile delivery. The losers included a stock we don't own, NIO. That's the Chinese Tesla, but much smaller. So we had the components of that sector, but we didn't actually have the car company that got put into the index actually a bit later on in the year, and has been an amazing performer. The others are, again, as I mentioned already, the often tourism or consumer plays affected by COVID. So what have we been doing? Well, Q4 and the end of Q3 saw us buying companies with operational gearing, as I've mentioned already. There's a cement company on the portfolio now. We had a couple of material names we added earlier in the year as well in copper. And banks again, remember them? Well, you don't get much more operationally geared than a bank. Other people's money and fine margins. Now, they have lots of cost-cutting potential still. They've probably over-provided if they're a good quality one. And this has been a very hard business when you've got an inverted or flat yield curve. But if we now get a positively sloping, steeper yield curve, it's not the hardest business in the world, is it? Borrowing short and lending long? Come on. So I think the tide's going to be behind these if the macro plays out as we expect. So we've started to add to those names. And of course, in emerging markets, we've got probably better banks to choose from than you would in developed markets, much healthier profit and loss and much healthier balance sheets. We sold the extreme liquidity sensitive names and the high beta names, such as the stock exchange. And there were some stock specific names here too, but I'm keeping an eye on the time and I'm going to keep rattling through. We'd early reduced the internet and e-commerce names, but I really do think we'll be back here. Structurally, they look, very, very good. We've just taken some off the table and think we're going to get better opportunities later in the year. And that means China was the funding source, really. As I said already, monetary policy here is tighter than almost anywhere else in the world, really, any major market anyway, which in the long run probably makes it a lower risk proposition. Why did we do all this? Well, I've mentioned a few things already, then a few spoilers, but we can see here the charts. This is why we've made such a change. The huge money supply growth which powered markets is now going into the economy. The economy is now soaring. Now, partly that's because if you stop something completely and then restart it, it will look like a V shape on a percentage change basis. But also this liquidity is being sucked into the system. Inventories were incredibly low and are having to be rebuilt very, very quickly. We're seeing huge shortages in many unusual places. Car components in Europe, they can't produce enough. Some of the plants have had to stop production because they lack some of the chips to go in them. There are ships queued up outside most ports, well, unless you're on the wrong side of Brexit, but they're queued up all over the world. Container prices are soaring. So we need to find the pricing power, the pinch points, because it's radically different. Some of the firms have been on the wrong end of this for decades, and it's snapped back. These price rises are being accommodated by the central banks, of course, like never before. So guess what? There's going to be some inflation. And it's going to be in unusual places and different places. This is not like the GFC response where there was lots of liquidity and it just went into financial markets. You don't have to take my word for this. You don't even have to listen to my anecdotes about supply chain distress. Look at the broad money in the left-hand chart. After the GFC, when they printed loads of money, it just went into narrow. Now it's broad money that is growing. The banking system was broken before and couldn't turn it into deposits and credit growth. This time it's different. It's actually normal this time. It was last time that was unusual. And it's feeding through already. The US is leading here too, because they led the monetary response. But China, you can see, much tighter and slowing. In fact, things are so tight there, I think they might ease next. This is very non-consensus, by the way. And you can see the export surge I mentioned earlier. So a tricky one for Biden straight away. So although we're thinking things might calm down a bit, we're not expecting any sudden rapprochement between the US and China. You can see why we've done things as we have here with the other markets. So in summary, the global V-shaped recovery is continuing to unfold, virus acceleration notwithstanding. There's an inflation rebound ahead, but central banks will remain ultra loose. It's too risky to tighten early, and all those central bankers have read the Ben Bernanke paper on Japan, and they laughed at the ECB in the early years when they were coming up the ranks. And they all agree on the orthodoxy. So watch the US Treasury market. Global money growth is still high, but temporarily below the surging industrial output growth. Some possible near-term drag on markets maybe as a result of that. It's already resulting in some churn, rotations, some of them quite violent. Again, you just keep watching that US Treasury and the rotations around from one sector to another. So there are some short-term reasons for concern. We call it an excess money air pocket, as short-term PMIs peak out a little. But I think any weakness here in cyclical assets would be a huge buying opportunity. So in the slightly longer term, over a 1-year view, it's a very favorable environment, maybe even a 2-quarter view for emerging markets, for old economy stocks, cyclical sectors, and even commodity prices. So watch out for the pricing power, the bottlenecks. They're in many, many new places. They're accommodated by the central banks. We've got to go out and find them. Thank you very much. I hope I've left some time for questions.
Thanks very much, Ian. So yes, we do have time for 1 or 2 questions. So just firstly, maybe, so what's your longer term view on emerging markets as opposed to some of the shorter term views that we have discussed during the presentation?
Sorry, Anna, could you just repeat that one?
So Ian, I was just asking about some of your longer term views on emerging markets as opposed to some of the more shorter term views that we've spoken about over the last few minutes.
Okay, thank you, Anna. Yeah, well, there's a few big themes that I like to talk about. One is that on the growth, and even though we've been taking profits in this area, in the long run, this growth in the technology and the internet is real. So as soon as all the Jack Ma stuff's calmed down and China's reasserting its dominance in this area again, it's very interesting to see how the lead areas in this are companies that actually form 2 clusters. One on the west coast of the USA, or it isn't just the Valley anymore because we've got Seattle and so on, and even a few in Texas, but most of them are on that west coast of the US. And in China, it's a little patch, a little stretch of land between Shenzhen, just near Hong Kong, and Hangzhou. And you've got Tencent in Shenzhen and Alibaba in Hangzhou, but those conurbations are packed with companies with really forward-thinking business models, and these are the companies that are leading the world. Rather like the 20th century and late 19th century was dominated, between cities, basically with New York on one side and London on the other. This is now the Pacific century, and these are the 2 leading areas. So we're seeing that whether it's bottom up or top down. And then we've got our old favorite here. This is reasserting itself. The financial markets lag, but economic power, trading power, and finally financial and political power as well, follows this sheer size argument. And you can see China and now even India starting to take their rightful place. This is a bit of an odd chart, but it's quite fun and it's quite colorful, so it's good on these sort of presentations. But you can see there the West peaked a very, very long time ago, and these countries are finally getting there. The financial markets will eventually catch up with this, and I think we are now at a key point in this trend. And then I mentioned about the companies that are becoming, they're dominating their home markets, usually China, and they're doing what the US did, and before that I suppose the UK did, and they're starting to go global. And we've got the likes of TSMC that we all know about, and Tektronix, but now we've got Geely stepping up, starting to dominate. China will go on to dominate the world, has already picked up a few brands like Volvo and Lotus. We obviously all know about Huawei, but then there's Midea in kitchen appliances. You really don't want to be a foreign competitor coming up against the likes of Midea or Haier. They absolutely dominate. And then if you've got an Amazon Prime or Amazon Echo, all the insides of that is done by MediaTek, and that's like a small part of their business. They are incredibly powerful. So we're starting to see brand names now and companies come out of these emerging markets, and they're starting to go global. In the long run, that's how we make money, right, as shareholders, through the companies, and that's starting to happen.
Okay, Ian, that's been brilliant. Thanks very much, and may the strong returns continue.
Thank you.